Hello, everyone. Welcome to the Ashworth Wealth Equity Market Update and Year-End Proactive Tax Planning webinar for 2024. My name is Todd McChesney. I'll be recording this today, sending this out. I want to kind of catch up on few things that are happening. Number one, we always want to remember that we believe at Ashworth that knowledge is power. We want to make sure we're educating you and you understand exactly what's going on. We want people to be able to make informed decisions and be able to help you plan effectively as it relates to you and your family and future generations. Agenda for today is pretty simple. We're going to talk about economic and market update, as well as do some proactive tax planning for 2024. We have about 7 weeks left before the end of the year, so some of these things have to be done before the end of the year, so we'll make sure we touch base on that as well. As usual, we give you a reminder of the 5 key areas of financial planning that we think are important: preservation planning, retirement planning, tax planning, estate planning, and investment planning. A lot of times we think that investment planning is the only thing that's important. All of these things kind of tie in together. A well-rounded financial plan and a comprehensive plan, and working with a comprehensive financial services firm allows you to kind of take care of all of these 5 areas. And we think it's very important that you look at all of those as we review your specific situations. 2024 has brought some interesting dynamics for investors. There's been some market volatility, political unrest, there's been fighting, interest rate changes, more inflation, but at lower rates, and a contentious presidential election, which has barely ended a couple days ago. So we'll kind of, as we look at what's going on, we have to understand how all these play into your planning situation. This chart shows the performance of the S&P 500 from January 2024 through the end of the third quarter. Clearly, things have continued to do well since then as well. But you'll notice that as the general trend, the market has had a good year, and you're seeing that in your portfolios. You're seeing that in your investments. We'll see how the end of year works. But as a general rule, the end of the year is usually better than the beginning of the year historically. Now, we don't know if that'll continue this year or not, but just be aware that there are some periods of time when markets do better than others. And the fourth quarter is usually a stronger period of time. But there are some major market concerns. You know, what's the direction of inflation? What are the interest rate changes? We'll talk about that a little bit in a second. Recession concerns. Geopolitical unrest, which continues, and obviously the thing that ended a couple days ago, the U.S. presidential election. So all of these have issues, are issues as it relates to markets and how markets perform, etc. So inflation is back to its lowest level since February of 2021. Now, when we talk about inflation being low, it's been about 2.5% as of August 2024. But that doesn't mean that things are cheaper. It just means that the goods and services are growing at a slower rate. So it's very, very difficult to get inflation back to where it was, or maybe not inflation, prices back to where they were, because once prices are raised, they're going to continue to be about that price going forward. You do not want deflationary situations, and the primary reason for this is that stalls the economy. So the best way to get out of a higher inflationary period is to get real wages up. And so we'll be interested to see what Congress and the new administration do on this. What can they do to ensure that people can continue to afford eggs, bread, butter, cars, houses, whatever? There's a lot of factors there, but I don't think that we're going to see milk, bread, and eggs going down where they were to 4 or 5 years ago, because once those things are priced in, they generally pretty much just slow the rate of inflation. So the key is to get real wages up, and we'll see what happens with that going forward. But there will be some exceptions to that, like if real estate can go up and down based on interest rates. But for the most part, once inflation goes up, it's very difficult for it to come back. It's just the rate of inflation growth that we're talking about going forward. The Fed funds rate right now, they had 11 interest rate increases over a very short period of time. We were starting at about 0 up to 5%. In September, they chose to drop rates by 50 basis points. I just heard a few minutes ago that the Fed is going to cut rates again today. So we'll see where that is. But that's a good sign for people that we need to borrow, and it also helps the equity markets, because people are able to move their money from high incoming earning bond funds or fixed income funds into equities. And so we'll kind of see how that plays out going forward. But for the right now, the Fed feels like they need to lower interest rates a little bit to kind of keep the economy going to avoid some recessionary influences on the market. As we look at inflation and interest rates, there's really two things here. They're going to reduce rates today. We'll see if they do it again. My guess is probably not, but they're going to figure out how best to keep inflation under control. They've got to, as inflation comes down, they can reduce those rates to spur the economy and help those real wages grow, but they can't do it to the extent of causing a lot more inflationary pressure. So it'll be interesting to see what happens, how much they do today. Is it a 25 basis point rate cut, or is it a 50 basis rate point cut, etc. The big issue we want to be aware of is we just don't want to see what happens to the dollar as inflation continues and recession concerns continue. You can really lose a lot of value of your dollar. So we want to kind of keep an eye on that. One of the reasons that we continue to stress the importance for having equities in somebody's portfolio is to be able to avoid some of these things that we just can't control. We want to focus on what we can control. We can focus on asset allocation. We can focus on not getting concerned when markets are good or bad or ugly, but we want to make sure we can focus what we can control. We can't control recessions, but we can make sure that we're positioned to be able to handle them appropriately, etc. The global economy is still in a vulnerable position. There are many issues going on between Russia, Ukraine, conflicts in the Middle East, concerns with China. There's trade concerns. There's a lot of different political ideas on how to deal with all these areas, and we'll have to see how those affect the markets here in the U.S. But for the most part, we don't have any major concerns on what that would do to portfolios or how to move forward politically as it relates to your portfolio. But the presidential election ended a couple days ago. We know that there will be a new administration coming in. We don't know for certain on who controls the House of Representatives. It does appear that the Senate will change hands from the Democrats to the Republicans. We don't look at that from a left versus right or a blue versus red. We look at it from I always say, take the neutral position, the green position, in that we're concerned about how that affects your money. What do we do to make sure that we're doing the right things and moving forward with your portfolios? Obviously, politics affects what's going on. It affects tax policy. It affects a lot of different things. So we want to make sure that we're aware how that's going to affect everybody's situation. The equity market outlook going forward, generally speaking, like I mentioned before, the fourth quarter is historically the best. So we'll look and see. Obviously, the markets did very, very well yesterday. They're doing well again today. A lot of that's because of interest rate reductions. And so we'll kind of continue to see. Ultimately, we always want to remember that markets perform in the short run based on fear and greed, but markets perform in the long run based on profitability. So we want to make sure that if companies are profitable, the market's going to grow. We want you to take advantage of that and be a participant in that situation. But once again, we always want to make sure that we have to have a long-term perspective on this. We want to focus on a long-term strategy. If you look at the 40-year return of the market, the 30-year return, the 20-year return, and even the 10-year return, markets have generally done great since 1980. It's been really, really a good ride. Having said that, when markets do really, really well, we have to understand there's also periods of time that markets do not. And so we want to make sure that we're being very, very smart in how we react to different geopolitical situations or things that we just cannot control. So what can we control? We can control your risk tolerance or appetite. That's important to understand. How much volatility can you handle before you make a bad decision? Risk tolerance is probably the most important things we want to track. What's your time horizon? We have so many people that say, well, I'm 65 years old. My time horizon is only 5 or 10 years or 15 years. Generally we want to make sure we go till you're about 90, 92. We generally expect that women are going to live to 92, men are going to live to 94. So it's kind of important because I say that backwards. Men live to 92, women to 94 on average once you get to retirement. So we want to make sure that we move forward and have the proper time horizon. If we take too little risk, then the inflationary concerns really, really start to hit us. A lot of times when I teach a class, I talk about the the importance of understanding inflation. And I go back to, I was born in 1970. A first-class postage stamp in 1970 was 6 cents. Today it's over 60 cents. I don't even know what it costs because now they say forever on them. And so we don't even know. But time horizon is important because we're going to live a very long time in retirement, and we got to make sure we account for inflation, et cetera, because we've got to overcome that cost in your portfolio. Your behavior, we can control behavior. Make sure that we're not making emotional decisions. We want to make sure we have a more practical understanding. So if you ever have any questions, we want to make sure that we can help you ensure that, maybe the best way to say that is to save you from yourself. And even as advisors, we have problems on this. We talk about it all the time. What happens if this happens? What happens if this happens? If this person gets elected, how's the market going to react? If that person's elected, how's the market going to react, etc. We want to make sure we can help you control your behavior, and then overall, we want to make sure that the overall strategy is moving forward. We have to stay focused on the overall strategy. It's so important that we not let things that we can't control our overall strategy. We want to be aware of what's going on and make sure we're being smart, but not make emotional decisions, etc. Warren Buffett once said, successful investing takes time, discipline, and patience. Time, discipline, and patience. His other favorite quote that I love, I mention to clients all the time, is he said, "You never know who's swimming naked until the tide goes out." And that's so important to understand. We have to make sure that we're diversified and prepared for turbulent seas or whatever's going to happen. He says it takes time, discipline, and patience. In the long run, go back to that chart I showed you, that 40-year plan, the market does well. We want to participate in that so we can have money to provide for what you want to do. So what are some of the key takeaways? Number one, caution is still the principal notion for investors. You always want to stay cautious. Inflation continues to be a catalyst for concern. It has been coming down, and we'll see if it continues to come down as the Fed continues to reduce interest rates. Interest rates are continuing to fall. They're falling today. They could continue in the future. We'll watch that and see. The Fed's going to watch and see how fast the economy heats up. And as usual, recession is still a possibility. Now, we don't always have recessionary concerns, but for the most part, we like to be very, very careful on that. As a general rule, we joke about economists because economists have predicted 11 out of the last 4 recessions. They're always predicting doom and gloom. But in the long run, we know that the market is going to grow. More people are moving here. More people are immigrating here. People are making more money. People are growing the economy. And that means that over the long run, even if we do have a recession here or there, we're going to be fine. And then long-term investing is this key strategy with equity markets. We want to make sure that we look at the long term. We want to keep you invested in both equities and fixed income as it relates to your personal situation and make sure that you're on top of those things. But for the most part, we have to make sure that we're still considered long-term investors. We're not going to be day trading. We're not going to be making decisions based upon geopolitical issues or local politics or national politics, etc. We're basically here to help make sure we're on top of each of these areas. So let's now talk about some proactive tax planning for 2024. We don't want to be reactive. We want to be proactive. And we have about 7 weeks left. Many of you we've already talked with. We've already kind of started this process, or some are still in our queue to deal with before the end of the year. We're going to talk about some of these strategies we're going to deal with going forward. Now, once again, I want to tell you there's a difference between tax preparation and tax planning. Tax planning is looking ahead before year end, whereas tax preparation is filling out your tax returns after year end. We always joke that by the time you meet with your accountant, CPA, or enrolled agent to do your taxes, the time for preparation is already passed. And so the time for planning is already passed. So we want to make sure that we plan appropriately and do the things necessary to get you prepared for when you meet with your tax preparer this next year. We've already done the tax planning necessary to be successful. So we have to do this before the end of the year. There are a couple of things we can do after the first of the year, like contributing to a SEP IRA or an IRA or a Roth. But for the most part, almost everything else needs to be done prior to the end of the year, etc. So we'll continue to watch that. So our strategy is to be proactive and not reactive. We want to make sure that we look at all 3 categories of federal tax brackets. First is the lower brackets. Okay, now these are going to be fine for the for the end of 2024 and 2025. The lower brackets are 10 and 12%. Then the next brackets are what we call the brackets where we should calculate what's going on. These are the middle brackets, 22 and 24%, And then the last brackets are the tax sensitive brackets, and that's 32, 35, and 37. So these are the categories. Lower should calculate tax sensitive. We'll talk more about that, what that means. But if you're in the lower brackets right now because of your income level or what you're able to live on and your financial circumstances, you're in great shape. If you're in that 22 and 24% bracket, maybe there's some tax planning concerns we've got to look at. If you're in the high brackets, there's not a whole lot we can do right now. We've got to wait until you're in some of those lower brackets. We're going to do some tax planning, etc. So we'll look at that and see. So let's look at that. We've got immediate needs, short-term needs, and long-term needs. We want to make sure that we're looking at all areas of these federal tax brackets. Right now for 2024, we're primarily going to work on the immediate needs, although those can affect short and long-term needs as well. If you look here on this chart, you can see that there's the current tax brackets on the left, the tax rates, and then the dollar amounts that are associated with those rates on your appropriate section. So if you're single, you're in the far left side, the married filing joint to the right of that, or even a qualifying widower. If you're married filing separate, or you're in that next one, and the last one is the head of household. As you can kind of see how those look. So for the most part, I'm going to spend more time on the married filing joint because that affects most people. But look at yours accordingly. So just remember, we have a marginal tax bracket system in this country. So everybody has a 0 or a 10% bracket. If you're married filing joint and your taxable income is below $23,200, then all of your income is subject to the 10% federal tax bracket. If your income is between $23,201 and $94,300 for 2024, then that portion of your income is between the 12%. So we want to understand how you're taxed on the margin. Remember, we're taxed on the margin. So not all of your money is at 10, not all of your money is at 12. Some of your money may be at 22, depending on where you are. So understand how this structure works, because it's very important as it affects your situation. And for now, that's how it is. It's going to be phased out in January of 2026 if Congress doesn't act. So we'll kind of keep an eye on that and see. But just remember that everybody has a marginal tax bracket, and it's where your last dollar is taxed. So if I'm in the 22% bracket and I take a $10,000 distribution out of my IRA, I'm going to pay taxes on the federal rate, 22% to pull that money out, etc. So a couple of things for 2024 we want to talk about. We want to make sure that we evaluate the use of itemized deductions versus standard deductions. You know, your itemized deductions are as according. I've mentioned married filing joint is what I'll spend most of my time on. That's $29,200. If you're over the age of 65, you get a little bit extra credit. But for the most part, we're looking at around $30,000 in standard deductions. How do we view those itemized deductions? The old rule was to accelerate the deduction, but now the new rule is to time or plan the deduction. We want to make sure that we do it at the right time. So there's many strategies we can talk about, but we want to make sure that we're looking at each year, am I going to take the itemized deduction, or am I going to take that standard deduction I talked about on the previous slide? We want to make sure I understand how those are going to be accordingly. So long-term capital gains rates for 2024 are listed here accordingly. So let's do the 15% rate. Most people that are taking capital gains are either going to be between above $47,000 or below $47,000. That is the number you want to keep an eye on. If you can keep if you're single and you can keep your capital gains below $47,000, you're paying 0% taxes on those rates, on those distributions. Excuse me. If you're married filing joint, the magical number is $94,000. We have several people that we work with that are selling businesses, and they're taking income, and almost all of their income is in long-term capital gains rates. A lot of times they're trying to keep that above about $124,000 a year. If you can do that, you get your standard deduction of about $30,000, and none of that money is taxed on an annual basis. So keep that in mind. Understand the difference between the ordinary income tax brackets, which were 10 and 12, 22, 24, I mentioned earlier, and these brackets, which are 0, 15, and 20. So those are the magical numbers. If you're head of household, your magical number is about $63,000. So we kind of want to keep the lower end on that 15% bracket, whether you're single, married, filing jointly, or head of household, because that's really the magical number there. So there's things we can do during retirement where we can make sure that we pay 0% capital gains rates by shifting where we're going to pull money each year. So that's very, very important to look at that before you're in and see how that's going to affect you specifically. Another strategy we want to look at and see is, are there any tax loss harvesting we can do? any capital gains distribution. I mentioned on the prior slide that you can take capital gains income and not have to pay any taxes potentially in certain years. Well, we can also avoid that by doing tax loss harvesting. A lot of people are saying, well, why would I tax loss harvest? Why would I sell something at a loss? Well, generally, sometimes we do that to avoid gains. So we can sell something at a loss, buy it back, buy something different. We can wait 31 days to buy it back to avoid the wash sale rule. We just have to be aware of that. But sometimes we want to harvest capital losses to be able to offset ordinary income. And you can use up to $3,000 of capital losses to avoid capital gains or offset ordinary income as well. So that's kind of a key to kind of look at that and see. So we look at that on an annual basis. This is $3,000 for a married filing joint. If you're single, it would be $1,500, be one half of that. So we want to make sure you understand. Sometimes it doesn't make sense to harvest capital losses because you're selling at a loss and then you're buying it back at a lower price, which means you're going to have a capital gain again down the road. But if we can do that, avoid taxes on $3,000 of income this year, and then down the road pull it back out at capital gains rate of 0, then we've got the best of all worlds. And so there's some strategies we can do to kind of make sure we're on top of that. I think that's the big thing to make sure we're on. We look at accordingly. We want to look at your retirement savings strategy before year end. Here are where they are. So if you're still working and you're contributing to an IRA or a Roth, you can do $7,000 per year. If you're over the age of 50, you can do an additional $1,000. The 401k elective deferral is $23,000 with the catch-up of $7,500. So if you're still working, you can participate in a 401k and you can do $30,500 if you're over the age of 50. Simple IRA contributions, not very many people have simples, but you have a simple IRA. That's a company-sponsored IRA plan, which is called a simple. $16,000 if you're under 50, $19,500 if you're over 50. And then the SEP IRA match limit is 25%. And the self-employed pension, the SEP IRA is 25% as well. So the overall limit is $69,000 if you're under 50, or $76,500 if you're over 50. So just kind of keep an eye on that. We don't want, once the tax year rolls over, you've lost the ability to do some of those, with the exception of the IRA, Roth IRA, and the SEP. Those can be contributed after January 1st. They're one of the only things you can do after the following year. So remember that. We'll want to make sure that we explore Roth IRA conversion benefits. We're doing this with many of you right now. As we look forward, I'll kind of go through this. Here are the advantages of that. Number one, it lowers your overall taxable income long term. If we can convert your Roth IRAs at the 10 or 12 or sometimes even 22% bracket, we can avoid those higher taxes down the road. You still get the tax-free compounding, but one of the biggest things that Roth conversions do is it means that you don't have to take required minimum distributions on that amount starting at the age of 73. So if I move $30,000 over from my IRA to my Roth, then I'm able to avoid required minimum distributions on that amount down the road. Not to mention it's tax-free withdrawals for you and for your ultimate beneficiaries. So there are rules on that. There's several 5-year rules on that. Just be aware. We want to make sure we're on top of that, and then we handle it accordingly. But most of our planning at the end of the year is dealing with Roth IRA conversions and avoiding and RMDs and avoiding future RMD important as we move forward to make sure we're on top of those things. We want to make sure that we look at your tax bracket. I skipped that slide, but we'll look at that. We want to make sure that as we go forward, what is are you in a higher bracket today versus you are tomorrow? So we'll look at that and figure out the best time to do it. Sometimes we do a Roth conversion in a year. Sometimes we do not. So it depends on the specific situation. So what is the annual gift tax planning for 2024? Many people call us and say, hey, I've got a lot of money, or my mother has a lot of money. She wants to make a distribution to the kids or the grandkids. What is the amount that you can do per year for 2024? That gift tax exclusion is $18,000. But if you pay that directly to a medical institution or pay some medical bills, that doesn't count for gift tax purposes. If you got a family member that's in some debt for some medical bills, you can pay that directly for them, and that's not considered a gift. So periodically people will call and say, hey, we want to make some large gifts this year. Mom or dad's about to die, and they want to give it to the grandkids before they die. Just understand that's the limit. If you do more than $18,000 per donee, then you have to file a 709, which is the gift tax return. We can help you explain that to you, but just be aware of what the situation is in that scenario. Also, if you give money directly to an educational institution to pay for tuition, that doesn't count as a gift as well. So if you've got somebody you're trying to help pay for college or graduate school, that does not count as part of that $18,000 gift either. So be aware of that. We don't spend a lot of time on wealth transfer because the dollar amount is so high right now, doesn't affect very many people. Just remember that the estate and gift tax exemption amount for right now is about a little over $13 million, but that is scheduled to sunset starting in January of 2026. We'll keep an eye on this. It's going to go down to probably around $7 million. So this just means that whatever you leave at death, if you want to give somebody, you can give away up to $13 million and not pay the 40% tax, but that's going to change. So this will affect more people in a couple years. We'll see what happens with the new. We've been kind of watching. We don't know if several weeks we've been talking about if the Democratic Party had taken control of the House, the Senate, and the presidency, they were probably going to make some changes to the Tax Cuts and Jobs Act from 7 years ago. If the Republicans take charge of the presidency, the House and the Senate, then there's a pretty good chance they're going to try to extend those tax cuts. And a lot of what we're going to be talking about will go on for a little bit longer. I don't want to get into political ideas of why this happens, but effectively it all comes down to what is called the Byrd Rule. Now, Robert Byrd, when he was a senator, passed a law that if you pass a tax cut and the Congressional Budget Office, the CBO, scores that bill, and that bill is not expected to, or that bill is expected to add to the deficit, then that law has to sunset. And so that's what we're dealing with. This law is scheduled to sunset on December 31st, 2025. Well, Congress can act. They just have to agree to it. And because they passed the law with less than 60 votes in the Senate, it wasn't a filibuster-proof vote, then it has to sunset. So if the Republicans and the Democrats can get together and kind of say, hey, let's extend this, or they agree, well, let's extend the child tax credit, or let's do away with the SALT tax cap, which we'll talk about in a second. There's things they can do, but we just don't know. We don't know who's going to have control of the House of Representatives right now. It does look like the Republicans have control of the Senate, and so we'll kind of see. But generally speaking, when you have mixed government, they get together and they're forced to compromise and do different things. They argue and fight, and they come up with some bill, and then they move forward. So we'll be interested to see what happens. But just be aware of some of these things we're going to talk about. We're going to talk about sunsetting in January of 2026. We just don't know. We assume they're going to sunset unless Congress acts. So we'll kind of keep an eye on that. Another thing that we want to look at before the end of the year is if you're eligible to do a qualified charitable distribution. You must be 70 and a half to be able to do this. By the way, it's not the year you turn 70 and a half. You have to be at least 70 and a half years old to be able to do this. So it allows us to do a qualified charitable distribution. You can do up to $175,000 a year. We're actually donating the money from your IRA directly to the charity or church or sports program, whatever you want to do. So that becomes very, very important. That's a big one. The other thing we have is the required minimum distributions start at the age of 73, and then we want to make sure that if you understand how QCDs work, you can do a QCD, a qualified charitable distribution, at 70 and a half. But once you're 73, anything you do in a QCD counts against your RMD. So if I have to do let's say I have to do a $10,000 required minimum distribution because I'm 73, well, I'm also over the age of 70 and a half, I can send that $10,000 directly to my favorite charity and not have to pay the taxes on the required minimum distribution. And I meet what the IRS requires me to pull out. So be aware of that. Now, there is a downside to this. The positive side is you don't have to pick up the income as taxable income. The downside is you don't get a tax deduction. When you're donating money directly from your IRA to a charity, that money is not yours. There's the thing called the law of constructive receipt. You've not received that money yet, and so that money has not been taxable, so you do not get a tax deduction. So we want to make sure on top of that, as we look at that, we understand how that affects your situation. Sometimes it makes sense to pull it out and then give it away. Sometimes it doesn't. Do you need the tax deduction or not? Are you itemizing your taxes, or are you taking the standard deduction? So I want to make sure you understand exactly how that's going to affect you going forward. So what are we looking at for 2024? We're looking at, as I mentioned before, the tax sunset. We'll want to make sure you understand exactly how that's going to be. Is it going to change? As of right now, the rates are expected to change unless Congress can act and get a bill signed. They're going back to the pre-2018 levels. The SALT cap tax will disappear. We'll talk about that. Child tax credit will revert back to $1,000, and the alternative minimum tax is going to start affecting a lot more people. So we'll kind of look at that and see. But this is kind of an example of the comparison that's going to happen between the two. So on the left-hand side is the ordinary income brackets today and the brackets for married, filing, joint, and single. And on the right-hand side is the tax brackets, what they're going to, and then the income earned to do that. And you can see that there's a major difference in these. For instance, if somebody's making $200,000 of taxable income in 2024, they're in the 2024, just the very top of the 22% bracket. But if they're making $200,000 in 2026, they're going to be in the 28% bracket. And so it's a major difference. Doesn't affect anybody at the lower bracket at 10%, but there's a 25% tax increase on people in the 12% bracket. It's going to 15%. So be aware of that as you look at this. How's this going to affect? Why would I do Roth conversions today? Because I know I'm getting the money out at 10 or 12 or 22% and not having to pay taxes on it down the road at 15 or 25% or even higher, depending on the situation. So we'll look at that and see. The dollar amounts that you see on those columns are actually adjusted to inflation, but the brackets are expected to change. So we'll see what happens. Only one bracket, the 35% bracket, is not expected to change, but the dollar amounts of getting into those brackets are going way down. So I want to make sure that we have a proactive tax planning approach in your situation. We want to keep you updated, know what's going on. We don't prepare taxes, but we do proactively prepare and make sure we're on top of moving forward what we can do. So what can you expect from us? We want to do a regular review of changes that may affect you. We want to make sure there's regular communication, more frequent discussions. Make sure you're getting our newsletter. If you're not getting our newsletter, please let us know. That's coming in the mail. We want to make sure that we review all economic and tax and estate investment issues and everything that we do. I probably go to 4 or 5 conferences a year just to understand the changes in tax law. So I want to make sure that we do that. We'll offer a workshop. We'll do one in the spring where we can talk about what's changing. We may know a little bit more by February or March on what's going on as far as tax policy for 2025 and 2026, but we want to make sure that we're on top of that and do things accordingly. So let me just kind of review one quick thing that I mistakenly forgot. On that SALT tax deduction, when I refer to SALT, I want you to understand that SALT tax stands for state and local tax. So when you look at your Schedule A of your tax return, your state income tax and your state property tax are all what we refer to as SALT, state and local tax. That is capped at 10% right now. There is a very good chance that no matter who wins the House of Representatives from this election, that there will be some changes to that. There are enough people in expensive states like California, New Jersey, New York, that have really high property tax costs. There's a very good chance that both sides of the political aisle will get together and make an adjustment there. So right now that's capped at 10%, or excuse me, at 10,000, not 10%. That's capped at $10,000 per year. So keep an eye out for that. So even if we have mixed government after this election is finally tabulated, there's a pretty good chance that some of these things may change. I doubt that the Tax Cuts and Job Act tax rates will be extended if there's mixed government. But there will be some things like the child tax credit, the SALT tax cap. They may do away with that. That's really, in a lot of people's eyes, harming people that have really expensive houses. They were able to take a tax deduction on those, and now they can't. So we'll kind of keep an eye on that. But we go to several conferences a year to kind of prepare for these things, to make sure we're keeping you in the loop and educating accordingly. That way in our meetings we can do that. So in conclusion, we want to make sure that we offer our service to other people like you. So if you know of anybody you want to add to our mailing list, if you want to invite a guest to a workshop or a webinar, if you encourage somebody to schedule a complimentary financial checkup, we're always looking to expand our business. We're looking for people like you that we can help. We obviously have our referral program, so people that refer us to people. We have a client advocate program where we do a trip every year. We take you on that trip and provide the entertainment and the lodging. This last couple of years, we've done that at Tuacahn down in St. George. We want to keep you informed. We want to keep your friends informed, and we'd love to grow our business by helping your friends. So please call us if you have any questions. As usual, we're here to help. If you ever need anything from us, reach out to us, call us, we'll schedule. We're finishing up some of our fall reviews right now and our tax filing stuff, but we're happy to help in any way. And we wish you guys a great holidays, great Thanksgiving, and a Merry Christmas, and we'll talk to you soon.